Welcome to the first chapter of our deep dive into the psychology of market execution. Today, we are stripping away the charts, the indicators, and the noise. We are looking directly at the most volatile instrument in trading, the human brain. We have all heard the golden rule of investing: buy low, sell high. It is the most cliché advice in finance. Intellectually, it makes perfect sense. It is simple math. To make a profit, you must purchase an asset when it is cheap and sell it when it is expensive. Yet why is it that when the moment actually arrives, when prices are truly low, we freeze? Why does buying low feel physically painful? And why do we feel paralyzed by the fear of catching a falling knife? Let's start with the biology of the crash. To understand why you struggle to buy the dip, you have to understand that your brain was not built for the stock market. Your brain was built for the savannah. It was built for survival. For hundreds of thousands of years, safety was found in the herd. If everyone else was running away and you stood still to look at the pretty flower, you were eaten. Evolution rewarded those who followed the crowd and punished those who acted alone. Fast forward to today. When the market crashes, when red candles are flushing down your screen and headlines are screaming recession, your primitive brain, specifically the amygdala, perceives this financial threat exactly the same way it perceives a physical threat. When you see your portfolio value dropping, your brain triggers a fight or flight response. Cortisol floods your system. Your heart rate increases. You feel genuine anxiety. In this state, buying low requires you to run toward the fire, while the rest of the herd is running away. Your biology is screaming at you to seek safety, which usually means selling everything and going to cash. This is why your brain rejects buying low. It interprets a low price not as an opportunity, but as a danger signal. Now, let's talk about the specific phenomenon known as the falling knife. In trading terms, a falling knife is an asset that has dropped sharply in a short amount of time. The term implies that if you try to catch it, before it hits the floor, you will get cut. You will get hurt. The fear of the falling knife is rooted in the fear of the unknown. When a stock drops 20%, you wonder, what if it drops another 20%? What if it goes to zero? This is where the psychology of loss aversion kicks in. Nobel Prize-winning psychologists have proven that the pain of losing money is twice as intense as the pleasure of gaining money. Losing $1,000 feels twice as bad as gaining $1,000 feels good. So when you see a market crashing, your brain isn't calculating the potential upside of a rebound. It is hyper-focused on the potential pain of further loss. You are paralyzed by the scenario where you buy, and the price immediately drops lower. You don't want to feel foolish. You don't want to regret your decision 5 minutes later. This paralysis leads to a tragic cycle. You wait. You watch the price fall. You wait for confirmation that it's safe. Finally, the market bottoms and starts to rally. It goes up 10%, then 20%. By the time you feel safe enough to buy, the opportunity to buy low is gone. You end up buying the middle, or worse, buying the top. So how do we overcome this? How do we rewire our response to catch the falling knife without getting cut? The secret lies in changing your definition of execution. First, you must separate price from value. When a market crashes, the price changes rapidly, but the value of a solid asset rarely changes as fast. If you loved a company at $100, why do you hate it at $70? The answer is fear. You must train yourself to view red days as a sale, not a burning building. Second, you must abandon the need for perfection. The reason you fear the falling knife is that you are trying to snipe the exact bottom. You want to buy at the absolute lowest penny, so you never see red in your account. This is impossible. You must accept that when you buy a falling knife, you will likely be wrong in the short term. You will buy and it might drop further, and that is okay. To execute during fear, you need a system that bypasses your amygdala. This is where strategies like dollar-cost averaging or scaling in become psychological weapons. Instead of trying to guess the bottom with all your money at once, you break your entry into pieces. If the market drops, you buy a little. If it drops more, you buy a little more. This removes the pressure of being perfect. If the price keeps dropping, you are happy because you get a better average price. If the price goes up, you are happy because you have already started your position. By accepting that you cannot predict the future, you release the pressure that causes the paralysis. The psychology of execution is not about eliminating fear. You will always feel a knot in your stomach when buying during a crash. The goal is to act despite the fear. Remember, the market creates the greatest transfer of wealth. During times of panic, your brain is hardwired to keep you poor by keeping you safe. To build wealth, you must learn to execute. When your instincts are telling you to run, next time you see the knife falling, don't try to catch it with your bare hands. Put on the gloves of a systematic plan, accept the imperfect entry, and execute. Because the only thing more painful than catching a falling knife is watching it bounce back up without you.